Welcome, everybody. I am Lori McLaughlin on behalf of Beth Veloz, who's here with us today. Yay! Our managing partner and the entire Archer team. We wanted to have a discussion about some sort of current topics that are relevant to energy investors. So, we're not discussing a specific offering today. As you guys know, any investment carries risk. This is just a general education webinar that's useful for folks to have given what's going on in the world today. Archer was founded in 2007 with a commitment to education, and you're seeing that here and are providing this discussion for you today. We've got the beautiful Beth Veloz, the managing partner, boss extraordinaire, and Sean Caldwell, who's the president of capital markets at Montego Minerals. And we wanted to bring them together today to have a discussion about what's going on with the Strait of Hormuz and how that impacts sort of mineral rights investors, oil and gas industry, and life in general. So this is a general conversation, not about any specific offering, but with information that we think it's sort of worth digging into a little bit and understanding better with somebody who is more knowledgeable about mineral rights and what's going on today. So with that, I will stop sharing my screen and Beth, ask you to take the reins, my friend.
Lori,
Oh,
thank you for the warm introduction. Can you guys hear me okay?
yeah, got you now.
Perfect. Okay. Lori, thank you for the warm introduction. Sean, it is always a pleasure to see you, my friend. We appreciate you taking the time to connect with us. Lori, that was perfect context to table set for what we'd like to do here this morning. So folks, those of you who are joining us, as Lori said, we have a deep commitment to education. And so education specific to investments clients are reviewing, but also education in terms of what's going on with the macroeconomic landscape around certain investments. And so that's what we want to take time to discuss here today. All of us are seeing the headlines regarding the Strait of Hormuz and a lot of information buzzing around in terms of how that's impacting a lot of aspects of daily life here in the United States, particularly for folks who are invested in energy. And so the goal today is that we cut through all that noise and we really just get straight to the signal of what's actually going on. So Sean, thank you for joining us, man. I want to get started with help us contextualize why this information matters. You know, as we're seeing headlines about the Strait of Hormuz daily, got Brent crude that has surged past $115 this past month. For mineral rights investors who are sitting here in the U.S., why is a maritime bottleneck, thousands of miles away, one of the most important factors impacting their royalty distributions?
Yeah, well, one, thank you for having me here. I think it's a wonderful question. I will say, and over the years of working together, I have just a ton of respect for Archer and y'all's desire to go through the noise and find the signal through education. So thank you for having us at Montego Minerals as some of the signal here. Now, with respect to the Strait of Hormuz, of course, right, we're 4 weeks into this. If you haven't had the news on or read a publication, this is 20% of the world's supplies go through this bottleneck, and without question, and we're seeing it, of course, in the spot price, whether it's Brent or WTI, is having a substantial impact to pricing because you have such a substantial supply offline. And naturally, and you see Brent and you see WTI, and you understand all these different pricing decks for the different types of supply, right? Brent being a more international price, and then WTI being West Texas Intermediate. And so when you look at how does this impact and how does it become a major factor in royalty payments going forward, is without question, if you look at WTI, that's what our royalty is paid on. And so every month, right? And so without doubt, those mineral owners today that have production that is owed to them, that is going to be paid on a much higher price than it was just 4 weeks ago. So returns, and that's why we like this asset. That's why we own this asset. It's a great hedge to rising energy prices and just inflation in general. We know that to be a pretty strong thesis, barring the fact that we've seen a massive spike here. So prices where they are today because of the supply crunch, Beth, is going to have an immediate impact. Now, immediate meaning in the next 60 days, because today's prices, which are March, let's call it, won't be paid out to us as a mineral owner until May. So that's typically the lag from prices today to when you start to see it as a royalty owner.
That is all helpful context and actually feeds right into my next question, which is on duration versus the volatility. So we've got some again, very jarring headlines, and having 20% of energy production offline is staggering. But the question remains, all right, well, are we looking at something that's more of a flash in the pan event, or given the scale of this disruption and its potential duration, I mean, you've got some people who are calling this the largest supply shock in history. Are we looking at this being kind of a temporary environment, creating some temporary spikes in prices that you can benefit from if you're on the energy investment side? Or is this something where it looks like we're going to see more structural shifts, suggesting the prices will remain at these levels, throughout possibly the end of the year, and we'll have stickier, price raises?
Right. Yeah. So I wish we all had a crystal ball here. Okay, because it's hard to say. I mean, whether it's a tweet or a conversation off Air Force One, it's hard to get a real good signal for where this excursion is going. Okay, and I think, in our opinion, because the amount of supply in the prior question that has been disrupted, and the shut-ins and the pressure drop and the systemic risk profile being now understood, we would say that the low will be higher. Okay, so let me answer that differently. We would, and our base case for oil prices on a go-forward basis before the war was $55 to $65 a barrel. That's where, all things equal, operators were going to make decent returns on capital through discipline, but also was a reasonable place where prices wouldn't erode or costs wouldn't erode margin. Now, that floor has absolutely risen. We would say, as we sit here right now, recording this on the 30th of March, right? We got to understand this is a very fluid world we're in right now, certainly from a news cycle standpoint. We would say that floor is probably 65 to 80. I mean, it's 65. If today we got a news cycle that the war has been resolved, ceasefire, and all the things on a peace plan have been agreed to, believe me, oil will not fall to 65, because, and if it did just on a trade basis, the supply disruption is so material because of how long it has existed. There's going to be some structural changes. Now, that also it needs to apply to the fact that Saudi Arabia and these other GCC countries are going to start amassing pipeline capacity expansion beyond this bottleneck. It's just the evolution of business risk and decision making that's going to come into play there. And albeit, and I think this is important, this will be my final thought here for you, and I'll pass it back to you, is that the United States is fairly insulated. Like, I think you hear about and have heard about how we are energy independent, both from an oils perspective, but also from a distillates perspective, whether it's diesel or fertilizers or other materials that oil produce. I think if this does drag on, right, if this is not resolved soon, fully expect the United States to pull the ladders up, and we will, through the likes of Canada as well as Venezuela, having enough supply. I don't want to misstate how oil prices are going to be much higher if this goes on longer, but we will not be Europe. Okay. And I think that's an important part, but it will drive a lot of value towards this real estate that we own, that is mineral rights, without a doubt.
That's, again, very helpful context and feeds right into my next question. Because if we've got 20% of global oil flows that have been restricted, and immense pressure now on U.S. production, across the basins that you guys are focusing on at Montego, particularly in the Permian, are you seeing operators turning on the taps and increasing volume, or is the industry still prioritizing capital discipline over growth while they're looking at triple-digit prices?
Yeah, it's pure discipline right now. I've been talking about this. This is the same conversation, or the question is the same question I've been getting for the last couple of years, and it's not going to change because oil goes up here. For sure, again, we need to evaluate the duration of this. So nobody has that crystal ball yet. But with respect to the operators in the Permian and even in the Haynesville out on the east side of the state of Texas, these are operators that have amassed a position of inventory that they are going to methodically manufacture. And without doubt, the prices up where they are, they're going to hedge some of that production just like they would. Now, mineral owners do not participate in hedges. So if they hedge their oil at 75 and it goes to 50, we're getting 50. If they hedge at 75 and it goes to 120, we're getting 120 as the mineral owner. So understand that, but operators have a ton of prudence today because we have had so much consolidation. And now the best acreage and the best geology in our country is held by only a handful of companies. And so we're excited about that. We like the methodical development schedule and the capital discipline that's going to play out here. And it'll be interesting to see what happens as oil. There's not a lot of demand, Beth, for oil at $120. I mean, even at 100, but certainly if we go to 150, by the way, we're not even talking about Russia's getting attacked by Ukraine and their ports. They just went force majeure. I mean, if you would have told me in this, if the landscape was what it was right now, and you would have told me this 4 weeks ago, and you asked me what I thought the price of barrel oil would be, I'd say it's way over 150. So with the SPR releases and I think a general sense of optimism, I think oil is actually at a lower level than most expect. And I think fundamentally it is lower than it should be price wise.
That's a very helpful context. And quite frankly, just being somebody who tends to err on the side of preferring methodical, disciplined approaches, it's heartening to hear that folks are staying the course on the operator side. Okay, so let's pivot a little bit to natural gas. While we're focusing on oil, the Strait of Hormuz is also one of the most critical arteries for LNG. How is the Middle East volatility spilling over into natural gas markets? And how does that change the yield mix for you guys in terms of the long-term value proposition for the gas-heavy portions of Montego's portfolio?
Yeah, so this is a really good question. I think for Montego, pre-Qatar, losing 17 to 20% of their supply for the next 5 years, that's kind of the estimation, 3 to 5 years. We were still starting to carve in a little more gas in each portfolio just as a function of recognizing that it's becoming a much larger, I mean, certainly a global commodity, but with the abundance that we have in country and then the lack of LNG exportation at this point relative to that supply, we are going to be fairly muted. So you haven't seen natural gas because of this LNG disruption go to $9 an MCF. The reason is the LNG exportation capacity we have in our country right now is maxed out. It's through long-term contracts, either through Mexico or Canada. And so the exportation expansion is continuing in our country. And you're going to have more coming online at the end of this year, 2026, and then even more in 2027. And so, and actually staged out to 28, 29, and so on. So that's why we love the narrative and the thesis around natural gas. But we are not seeing, and actually I think we're great beneficiaries of this as consumers and to protect our economy in country, is that while they are largely feeling this in Europe, more specifically. I mean, you saw natural gas prices, spot prices go up 40% in a day. I mean, that's wild. And so we didn't see that because we have so much of it. But we are adding more and more. We're never going to be overweight gas. I want to be clear. We'll see this matrix be 60-40 kind of on the high end in any of our portfolios, 60% oil, 40% gas. But we're kind of in that 70-30 right now. That's what we found to be the right yield mix. Or to provide the right yield mix relative to the commodity exposure. And we love the Haynesville. It's just a wonderful basin. Texas, state statute when it comes to energy, right? Pro energy, and just the best capital working over there. So yeah, that's what we're excited about on the natural gas side.
That's all really helpful. Thank you. Okay. So we want to make sure that we keep this concise and tight for folks, given how busy schedules are. So there's one last question that I want to use to sort of frame all of this as we wrap up. So for investors who are thinking about mineral rights and energy in terms of where does this fit in the landscape of my personal investment portfolio, especially with oil prices sitting at historic highs, how should they be evaluating today's environment as an entry point? Is the value today driven by immediate cash flow, or should they be looking at the undrilled inventory and geology as their primary margin of safety? How are you guys thinking about this as an entry point into this market?
So we want to lean into the latter there. That's on the future undeveloped, or the proven but undeveloped locations. And this is such a great question because it always comes about either in price spikes or price falls. And when prices spike, what happens for Montego is something that we love to happen, which is the non-sellers, the mineral owners in our country that are on the sidelines, not sure if they should ever sell their mineral rights, come to the table. They start actually returning our calls. They answer our mailers. And they don't, because Montego is such a great engineering firm, but they don't know what it's worth. We can provide a valuation. And at that point, we build this relationship. And Beth, Montego, we're a 3-generation family-owned business, and there's a lot of credibility that goes into our ability to work with these families with a level of trust. And so if they say, well, hey, oil's at 100, shouldn't this price be higher? We can show them through the economic runs that we have a long-term, I say, instead of a 10-week horizon on view on price, we have a 10-year horizon on price. And if you look at the prior 10 years, oil has averaged $65 a barrel. Our base case going forward for the next 10 is $75 a barrel. So we will run our economics around 60 to 70. We don't go to 75. So $60 to $70 a barrel on the production in place today. And we discount all the future values substantially to that owner when we make that offer. And so what today's prices have done for us and all of our mineral owners, both today and then going forward, is it brings more sellers to the table. And that's what we love. Actually, as we're talking on 3/30, so March 30th, 2026, we have over 125 million in our inventory in evaluation right now. Typically, we have anywhere from about 50 to 75 million. So that has gone up over the last 3 weeks with people calling saying, yeah, give me an offer. I want to see the offer now. And it's driven by their emotion to price, but fundamentally, we don't make acquisitions based on price. We make it based on the geology in place, the ultimate economic recovery there, and then how does that tie into an IRR for our investors? So is very much an arithmetic, a math equation, I'll say. But there is always emotion from the sell side. And I think Montego has done such a great job in building relationships and building that level of trust that allows us to find these assets.
And that is a very helpful note to end on. And I feel like if I heard you correctly, it sounds like with all that's going on in today's world, it's loosening the markets so that you can see more transactions happen. And as markets loosen, you get transaction velocity that picks up. You see a healthier rhythm established in terms of acquisitions, which creates a lot more opportunity at scale for people to get in here. But you guys are staying the course and acquiring at disciplined levels, disciplined price points. So that way, you can take the advantage of the markets being more open and you can make your acquisitions in a larger scale, but you're staying the course. And then as you see potentially higher prices stay stickier for longer, you'll eventually benefit from that in the long run. So man, that's a very helpful note to end on. All right, so as we wrap up, any final comments or thoughts you want to leave everybody with?
I think the last thing I would say is just this is such a fundamentally prolific real estate investment if you have the opportunity to own it, because only in the United States can Beth, you, I, Lori, can we, the citizens of this country, own this asset. In no other country is that the case. And we've been talking about how you should own mineral rights at some level because it's such a great hedge. There's no expenses, there's no costs. You don't have to. There's no terrible teas, trash tenants, toilets. Right? It's a great asset to own that will pay for generations. And so Montego is that. I guess we're the lighthouse, right? We are a group that has a great track record in not only underwriting and acquiring these assets, but also managing them and understanding when the right time to sell them is. And so we always appreciate the opportunity to talk with you and the Archer team. And, we're always available to open our software. I think that's a big piece. Obviously, we're not sharing screens today, but, we're data driven on everything we do. And we rarely bring any emotion into what, allows us or drives us into any type of acquisition. So thank you, Beth. And Lori, appreciate you guys.
Yeah, thank you for the time. And folks, to wrap up on my end, and then Lori, I'll pass it back to you, my friend. Today's, again, the goal was to give you kind of a tight 10, 15-minute summary of here's some cutting through the noise and getting to the signal of what's actually going on. As this provokes further questions, please feel free to reach out to your Archer contacts. We are more than happy to dig deeper with you at the Archer level and also loop in Sean and his team there. Excellent at helping create real clarity in terms of the economic factors impacting this asset class. All right, Lori, I'll let you close us out, my friend.
Well, I just want to thank both of you. This is sort of a very timely conversation, and it's really important to our investors and for folks who are learning about this to be able to have access to this kind of conversation. Really appreciate it. Both of you, thank you so much. And folks, if you have more questions, reach out to your point person at Archer. We are here for you. And with that, have a great rest of your day, everybody. Bye.
Thank you.